Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so for well over a full year now, had been and still is, though it was once again breached and repaired only a few weeks ago. It is the dark blue September to December 2024 bear channel, which is currently 1153 to 1599. That has developed into a descending, expanding wedge pattern. We are today under also all the moving averages, of notably the mauve medium moving average, currently at 1599, being in lockstep with the dark blue upper trend line. There are two other patterns that have greatly influenced this market. The first, the origins of which I've spoken about at length, and it is the green late September 24 to mid-January 25 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 32 weeks ago, and it seemed back then to be a better contender in showing the bearish angle of attack. But this is no longer true, and I finessed it to the shallower bearish shift pitchfork for the same move, which is much better at showing the bearish angle of attack today. Now today we are all in between the overhead bright green middle tine, currently at 1564, and the bright green lower tine, currently at 1338. The second is another larger bearish pattern, which I had also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is a longer term bright red November 23 to September 24, similar but slightly shallower bearish shift pitchfork. On this one we are just below the bright red middle tine, currently at 1487. The break below the bright red middle tine last week pushed down below the previous significant low in late June at 1468, down to a new low, one that's not been seen since December 2020. Indeed, we dipped down to that December 2020 low at 1409 during the middle of last week. However, prices have backed off higher from this low because, as I said last week, and I quote, we next have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle tine. Well, we've had that stabilization. We're now sitting in between the bright red middle tine and the congestion below. Looking further below, well, we don't have that much support until the 1248 level, and I'm not too confident on that one as well. We also have a gap between 1336 down to 1320, dating from September 2020. On top of all that, last month was a monthly key reversal down, a bearish factor, though I can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise, the pressure is still on the downside. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. The first of the three patterns is the obvious broken, repaired, broken again and lately repaired, purple late September 24 to mid-February 25 descending expanding wedge pattern. That's currently 442.5 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary made back in January this year, and had earlier been severely tested on the top side, enough that I would not necessarily classify as a descending wedge pattern after February, though I continue to still keep an eye on the extension to the purple upper trend line and the recent failed break above it, as well as a changeover gap 7 weeks ago, as I believe it ought to be significant. Next, I also asked you 27 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market started utilising the bright pink middle tine of this bearish shift pitchfork, currently at 460.60, as an attractor, riding prices lower in a shallow glide until early October, when it started a further steeper journey lower, such that the market is now closer to the pink or lower tine, which is currently at 402.20, and might be acting as a potential support, the first time in the life cycle of this pitchfork. The third feature now comes into play, along with a new feature. That's we have a fourth, though we will probably go back down to 3 features. We actually will go back down to 3 features after this commentary. The third feature is the rectangle pattern formed between June to September, which, when we had a break lower in early October, gave a primary target of 436.20, reached 3 weeks ago, and the secondary, harder to reach target X, but the same move, down at 418.80. Last week the market reached the secondary target, and thus I will remove it after this commentary from my daily chart. The fourth feature has developed over the last few weeks since the beginning of September, and is the red bear channel, currently at bright red bear channel, currently 404.30 to 435.80. This has been excellent at showing the very recent bearishness of the market, and it shows last week's low at 410 as being the lowest low since December 2020. There's one final thing I would caution you about. The red lower bear channel line crosses the pink lower tine later this week. I would look out for some potential volatility around the middle of the week, perhaps. Sugar white premium spread. 7 weeks ago here I said, and I quote, "Things seem to be trying to resolve themselves into a pattern," end of quote. And over the intervening weeks they seem to be doing so, just not always the way that I imagined they would. You see, I thought we might be moving towards, as I cautioned for a number of weeks, and again I quote, "I haven't a fear, and it is a real fear, that the whole February 2025 to action might be trying to form a possible diamond pattern," end of quote. Now I continued, and I once again quote, "This would be a large pattern in time, probably from February through to November this year, and in height roughly between 100 up to 150. It is too early to say if this is happening, but I urge you to keep an eye on such a possibility," end of quote. That possibility looked like being a real possibility until 7 weeks ago, when the market dropped down and below what I thought would be the lower bullish trend line, highlighted in dark blue, which is currently at 122.5. The market not only dropped below this trend line, and let's be honest, it's an unjustified trend line, but went on to drop and close below the gold long moving average, currently at 105 even, and stabilize further down, dropping and closing below a new support line, the bright red neckline, currently at 97.5, of a new, simpler pattern that the market opted to utilize instead of a more complex diamond pattern. It's a February to early October head and shoulders top. We were, and I suppose still are, at the early stages of this pattern, but I thought it was appropriate 4 weeks ago to lay out some potentials below for such a pattern, just in case. Thus, a primary target X is down in the 70 even zone, with a secondary harder to reach target X1 down at 43 3/4 zone. You will easily note that the primary target X is at the lower end of the congestion seen between September 2024 to January 2025, between approximately 70 to 85. Since then, prices have stabilized, apparently not following through lower, opening and closing over the bright red neckline, if still below the gold long moving average. However, last week had perhaps a significant weekly bearish engulfing pattern that closed back on the bright red neckline. It continues to be, as I said 4 weeks ago, and I quote, "Only concerted, consistent and long-term moves over the bright new red neckline, and ideally over the slowly rising or long moving average, could possibly assuage the bearish potential, at least as far down as 70 to 85 congestion," end of quote. We had been half there and half not there, but perhaps last week's bearish action might start something. But looking right now on the first day of the new week, it does not appear to be the case at the moment. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.